Here's one of the smartest investments that no one's talking about: life insurance.
Insurance secrets only the rich know.
Here's how you become your own bank using something called infinite banking.
Here's how it works. You put your money inside a life insurance policy.
And that's what a lot of these rich mofos are doing.
It's whole life insurance. And this is probably the most underrated, undervalued investment of all time.
Life insurance is the world's safest industry. There's an account that yields 5 to 6 times more than long-term CDs, has guaranteed returns in most cases, does not have to be reported to the IRS, can be accessed by any time without penalty, lets you retire 100% income tax-free, and yet almost no one knows how wonderful these plans are because the government places tight restrictions on the advertising of these accounts, even though they are 100% legal. Why are they secret? I'll tell you in a moment. The government places tight controls and restrictions on the advertising on these accounts because they can't make a dime off of them.
All right, guys, we're going to talk about it today. If you look anywhere on the internet, on TikTok, on YouTube, on Facebook, it seems like this pops up everywhere. And infinite banking is either the best kept secret that everyone doesn't want you to know about, including governments and banks and all these other institutions, or it's one of the biggest scams ever. And in this video, we're going to break down exactly how it works and what I think about it. What is up, guys? For those of you who are new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting, I'll put a link in the description below and you can check it out. But without further ado, let's get into this video. Okay, before I actually break into my thoughts about infinite banking and how it works and what are the pros of it and what are the cons of it, I need to first explain to you my history in this insurance industry and my background in the insurance industry, because this is very important. When you're watching videos, whether this video right here or other videos on other channels or other TikToks or other YouTubes or all these other places, you need to take in the context of who is making the video. You need to understand what biases they come from, and you also need to understand what their experience in the industry is, because you can't be taking financial advice and insurance advice and real decisions that affect your financial well-being from someone who, I'm sorry, has only been in the industry for like 6 months or a year and a half, and they don't have a background of working in this type of strategies. And so I've been in the industry almost 10 years now. Most of my work in this industry has been done working with high net worth business owners, creating complicated estate plans, working with other lawyers, working with other accountants, creating holding companies and family trusts, and doing large life insurance policies like they talk about in these TikToks, big whole life policies, $100,000, $200,000 premiums, leverage in it, borrowing against the cash value in it. And so I have quite a bit of experience when it comes to these type of strategies. I also have built an accredited curriculum here in Canada that's accredited in multiple different provinces that explains how this type of strategy works, where all the pros of it, all the cons of it, how the taxation works, how the strategy works, how the leverage works, who this is right for. And so I've spent a ton of time researching this topic. I also have white papers that I've written. And if you're interested in either of these things, just drop a comment below asking for them and you can have them. I have white papers specifically on this topic where I talk about the complexity of it, where it's good and where it's not good, that have been peer reviewed by lawyers and other financial professionals. So I'm not trying to brag to you guys, although I am trying to explain that I do have a little bit of history with this type of strategy. Now, specifically for infinite banking, we have a little bit of a background since I guess started really in the industry. Now, if you Google Philip Setter and infinite banking, you will find several different articles where I've been featured in prominent insurance companies and where I am an advocate against infinite banking. However, clearly in the article, I am saying it can be beneficial for some people. And by the end of this video, you'll know exactly if you're that person or not. But let's just start talking about infinite banking and get into it, because it just seems like if you go anywhere on the internet that it's this massive secret of the wealthy. I mean, you can see just from the TikToks that I had at the beginning of the video, is like secret of the wealthy. The banks don't want you to know. The government doesn't want you to know. So what the hell is infinite banking? Okay, here's the thing. Whole life insurance has been around for hundreds of years, okay? And the ability to, what they say, leverage against it, borrow against your policy, that has also been around for hundreds of years. That is not a new thing. However, infinite banking banking is essentially a group of people that got together, one person specifically, which is this guy right here. Can I focus on that? Nelson Nash, and he wrote this book called Becoming Your Own Banker, okay? And he got together with a bunch of other people and he kind of came up with this strategy. And listen, at the end of the day, the core mechanics of infinite banking are very similar to the core mechanics of simply buying a whole life insurance policy and borrowing against it. I mean, that's essentially what it is. The only difference is infinite banking is wrapped up in this whole marketing pitch and this whole unified front where it seems like every single person has the same message. And what message is that? Well, the primary message that infinite banking practitioners have is that governments are out to rip you off. Banks are out to rip you off. Everyone's out to rip you off. They're very distrustful. They're very right-wing leaning. And thankfully, insurance companies are here to save you. So infinite banking knows who their target market is, okay? Their target market is exactly that. Right-wing leaning individuals that are very distrustful of systems and government and banks and other institutions, and they somehow convince them that insurance companies are the one that's going to save them, but they know who their market is, and they really play up to that in all of their messaging and all of their marketing. And by the way, if you wonder why all of their marketing seems to be all on the same point, it's because infinite banking is an institution, okay? So here's the thing. Any insurance broker can go out and they can get licensed and they can have the ability to sell permanent life insurance that you can leverage against, you can borrow it against, okay? Anyone can do that. However, to be an infinite banking practitioner, you need to go to this institution and you need to take their schooling and their education and get licensed in their way of thinking, which could be good, it could be bad. I think it is actually very good that they do have a further level of education that's required for you to call yourself an infinite banking and practitioner. At least they're educating people. Even if you don't agree with the education, at least they're educating them. Because here's the thing, I don't believe that any insurance broker should be able to do a 1 week or a 2 week or a 3 week course, get their insurance license, and then go out and be able to sell $100,000, $200,000, $1 million a month or a year, policy to business owners or wealthy people. And they really have no idea how this works. So at least infinite banking is doing a little bit more education. So here's the thing though, if you look at the marketing though, I mean, they know their marketing. Their marketing is like wealthy people, this is secrets, banks, government, very distrustful. We hate all these people. And if you're on our team, come on over and insurance is the answer. Now, listen, here's the thing. I've talked with a number of different infinite banking practitioners leading up to this video to try and get their opinion and to try and get their viewpoint on how this entire thing works and what they think about this strategy as a whole. And it's one clear thing that I found with every single one of them. They all have this kind of aura of like, you need to unlearn everything that you've been taught. We need to essentially brainwash you to come into our little cult, quote unquote. And we need to really, take everything that you know and throw it out the window because we're about to reteach you all these secrets and all these different things. And at the end of the day, infinite banking is simply another form of a leverage strategy against permanent life insurance. And I'm going to talk about it in this video, and I've talked about it in other videos, but let's actually break into what are the basics and how does this thing actually work. So when I talk about leverage strategies, I'm talking about buying permanent life insurance that has some type of value within it. Now, again, there's two different types here in Canada and America for that matter. We have whole life and universal life. Now, infinite banking practitioners will only be doing this with whole life. They don't ever touch UL for the reasons that UL is more sided with the bank, and they also try and stay away from collateral loans. And we'll talk about that. Don't worry. We're going to get into all of this and what it means. So don't get stressed out. Okay. So here's how it works. All accumulation or leverage strategy is buying a permanent life insurance policy with some type of cash value. Now, this cash value is going to grow tax exempt within certain limits, and you should always stay within those limits because the insurance company does a really good job of letting you know what they are. And so you can put it up to the maximum and you hopefully will never go over it. So you put in a bunch of cash into this policy and you get two things. You get a death benefit and then you get a cash surrender value. Now, the way that you're going to structure it is you're going to structure this with something known as paid up additions. So what does that mean? paid up additions is essentially the insurance company is going to receive your premium. And let's just say it's $10,000 for the year. A portion of that is actually going to be the cost of insurance, and probably going to be relatively low depending on how old you are, but let's say it's $1,000. That means the insurance company then has $9,000 extra dollars that they can essentially quote unquote play with. The insurance company will then take this money, they'll invest it into a multitude of different projects, whether that's real estate, alternative investments, or policy loans to other individuals. Whatever it is, they go out and they make money on the money that you gave them, and then they return you a dividend. And now there's many different ways you can receive this dividend, but the most common way when it's structured like this is for paid up additions. And all that means is that your face amount is going to grow over time. So maybe your death benefit was, let's say, $1 million, then it was 1.1, 1.2, 1.5, 1.6, etc., etc. And by the way, the dividends that they return you are tax exempt, meaning you don't pay tax on them. So the face amount is going to grow over time, as well as the cash surrender value is going to grow over time. So maybe it was $50,000 to start, and then it was 60 and 75 and 100, and it kept growing on and on and on. Now, the strategy of borrowing against a life insurance policy is quite simple. You have this cash surrender value, and you can take what's known as a policy loan against it. That's where you're getting a loan directly from the insurance company that you took your life insurance policy out for. Now, when you take this loan from your insurance company, you're going to be paying an interest rate on that. So that could be anywhere from 5 to 6%, somewhere in that range, depending on what the interest rate environment is. And now what you should be doing with this loan is you should be putting it into some type of investment or some type of business. If you do that, you can actually write off the cost of the interest. But what's happening within this policy is you're essentially banking on the arbitrage between what the insurance company is earning, which could be anywhere from 6 to 7% and returning to you, and what you're paying in interest. So maybe you're paying 5, 5.5, 6% interest, and then maybe the dividend scale is 6, 6.5, or 7. So what you're really getting is that arbitrage between what you're earning in your whole life policy and what you're paying as an interest rate. And now there's a couple different ways you can structure this. So one of the ways you can structure this is you just, simply pay that interest rate, and you pay it every month, and hopefully you pay this loan back. You buy some type of investment or some type of business that starts earning you money, and then you take that money, repay the loan, and then it's paid off. Or the other way that you can do it is something known as capitalizing the loan. So capitalizing the loan means that you essentially stop paying the loan, and it just gets tacked on to the overall bill, and it compounds essentially until you die. And then the life insurance company says, no problem, as long as it doesn't exceed the loan to value, which is usually 90%, we'll just wipe out the loan from your death benefit, and you'll have a reduced death benefit. Maybe it was $1 million, but your loan was, let's say, 800,000. So we wipe the loan out, $200,000 goes to your beneficiaries. Now, I hope I haven't lost you yet. You're probably thinking, that sounds really complicated. I don't get it. What's the whole point of doing this? Like, that doesn't make sense. Why are we buying a life insurance policy? Why do we have to do this? Why do we have to do that? It doesn't make any sense. Here's the real core fundamental, okay? If you start to allocate money towards a life insurance policy, that policy that has cash surrender value is going to continue to grow. Okay, so now you have this asset over here that's growing. And now at certain times throughout your life, and especially after the early years when it starts to grow and gets to a sustainable point, you now have the ability to take that capital and invest it in other things, but you're not actually affecting the growth of that policy. So it's still going to continue to grow no matter how much you borrow out of it. So you can borrow all of it, as much as you can out of it, and it's still going to continue to grow at the exact same rate. And so what it really allows you to do is have this wealth building mechanism over here, which is going to continue to grow, okay? And then it gives you the flexibility to then take that capital as things come up. So maybe, I don't know, an apartment building that's a really good price and it's in a good economy and we're going to make a bunch of money from it. Maybe it comes up, you say, oh, this is a good time. You borrow that money, you put it over there, you buy this real estate building, and now you're earning something over here and you're earning something here. So you're kind of double dipping. So it's just like if you kind of start to wrap your head around it, it's like any other type of leverage strategy. So I mean, another common one is like, should you pay off your mortgage? If we actually run the mathematical equation of whether or not you should pay off your mortgage rates are typically 3 to 4%. So essentially, if you pay off your house, you now have, if your house is worth $500,000, let's say you can borrow 80%, you have $400,000 of cash there that you can borrow at 3 to 4%. Well, if you can get a 6 to 7% net investment, you're really, if you do nothing, you're losing net 2 to 3%. right? So it's the same thing. The only difference is whole life insurance has some very specific tax exempt policies that apply to it, and it allows it to grow tax exempt, which is very beneficial. And furthermore, there's a mechanism to repay the loan should you die. So it's just a very good mechanism for leverage strategies. Of all the leverage strategies that you can do in the world, I think it's one of the best leverage strategies that are available. I mean, there's lots of different ways you can do. You can borrow against your portfolio and then lend it into other portfolios. You can do option trading. You can borrow against your house as something called the Smith mechanism or the Smith maneuver. You can borrow against your house and then put that into another type of investment. So there's many different ways that you can leverage things. I think life insurance, specifically whole life insurance, is just one of the best ways you can do it because of the tax exempt status and the mechanism to repay the loan upon death. However, there is some drag within this type of policy, and there's some losses and extra fees that come along with it that you need to be aware of. So one of the things right off the bat is there's extra fees that come along with this type of strategy. So you're paying a commission to the insurance advisor, you're going to have some fees in the beginning, and this type of strategy takes a while to build up value until it becomes applicable. And so if you're looking for something short term, this is not a good place to put it. So the fees are one. There's also the interest that you have to pay on your loan. You still have to pay to borrow that money. You're going to be paying that interest rate. And yes, if it's for the purposes of business or investment, you can write it off, but you still need to take that in consideration that A, you need to continue to pay for the policy, and B, you need to now pay for this interest cost. And the third one that you need to be very careful of is there could be a circumstance in which case your policy loan becomes taxable. Now, here's the thing. So in the United States, their legislation is very simple. Policy loans are never taxable on a whole life insurance policy. However, in Canada, our tax system is a little bit different, okay? So the way the policy loans work in Canada, they are actually considered a disposition in the eyes of the Canada Revenue Agency. And so how you get around that, here's the thing. In the early years of your policy loan is probably not going to be taxable because your adjusted cost basis is very high. And that's a simple equation. If your policy loan is in excess of your adjust costed basis, then it will become taxable. And so in the early years, that ACB is quite high. However, in the later years of your policy, it does start to creep down and get lower and lower and lower. And hopefully, essentially, it will get down to zero. And so in the later years, your policy loan can become taxable in Canada. United States, totally different. Canada, it can become taxable. So this is something that you need to take in consideration. Now, the way that you get around this is there's something known as collateral loans. Collateral loans are from a third-party lending institution, such as another bank, and you pledge your asset to the bank and get a collateral loan. Now, that is not taxable in Canada as of 2023. Maybe it will be in the future. I don't know, but it's not taxable today. Now, this does inherently go a little bit against the infinite banking concept because they really do believe that, banks are the devil and we shouldn't give our money to them and we become your own bank. That's essentially the entire principle. And so it does kind of go against the grain of the concept. However, at the end of the day, it still does make the strategy, applicable in Canada. You just need to be aware it's a little bit harder to qualify for that type of loan than a policy loan. A policy loan, you can have access to it. There's no credit worthiness. It doesn't matter what amount you're trying to get. But with a collateral loan, they are going to look at your credit worthiness. They are going to see if you have good credit. If you have bad credit, you might not be able to get it. And they also are going to look at how much do you want to borrow. Typically, they don't want to do this on small amounts. They want to see like a significant amount of cash value. Most lenders want to lend above $500,000. I'm not saying there's no lenders that'll do it under $500,000. It's just a little bit harder to work with. There's less people that do it. There's less banks that do it, pardon me. You might not get as preferential rates as the other lenders are willing to give over $500,000. So I'm not saying that it's impossible. It's just a little bit more difficult, and it's something you need to keep in mind. Another thing that you need to keep in consideration when considering this type of strategy is the high degree of commitment that's required. So here's the thing. We're not robots, okay? We're not human beings are not robots. I had a conversation with a friend the other day, and I think he was like 5 years out from paying his mortgage off completely. And I was explaining to him, I said, hey, listen, man, you could make way more. I don't know why you're paying it off. Well, it's like 3 or 4%. You can lend that out, or you can take that money, borrow it, and put it into some type of investment. And he's like, yeah, I know I can, but at the end of the day, I don't care. fine, I might lose a little bit of money or a lot of money. I don't care, but I just want the security of knowing that it's paid off. I don't have to worry about it. If I lose my job, whatever, I go on my way, the house is paid off, I pay the property taxes, and I'm good. I'm done. We're not robots, okay? So when you look at the numbers, especially some of these strategies can be incredibly valuable. And I remember when I got started in the industry and I would look at these Excel spreadsheets and I would look at all these numbers and I'd be like, oh my God, how could anyone not do this? And then I would try and sell it to clients and they were like, yeah, but then there's this commitment. Then I have to pay that. What happens if I can't pay 1 year? And I was like, oh, well, you'll lose everything. But why would you not pay? And I didn't realize that it's because just because something looks good on an Excel spreadsheet doesn't mean psychologically that it's a good idea for everyone. Does that make sense? Do you understand what I'm trying to say? Just because it's good mathematically, we're not robots, okay? And if you can't diligently follow something and commit to it, then it could collapse and it could cost you a lot of money. So for this type of strategy, if you're looking at it, you need a high degree of commitment. If you cancel within those early years, there's a good chance you're gonna lose some or all of the money that you put in, especially in year 1, 2, 3, or 4. I mean, there's just not a lot of cash value built up at that point because of all the associated fees. It really doesn't start to break even until year 7, 8, 9, and then it really starts to pick up momentum and go from there. So it has a high degree of commitment. The other thing that you need to be aware of is the leverage. This is something that you're going to be continuously doing. You're going to borrow, you're going to pay back. You're going to borrow, you're going to pay back. You're going to borrow, maybe you don't pay back. Maybe you capitalize it. And now this loan is just creeping up as you move forward. And you'll start to think okay, I don't know if I'm comfortable with that. So, it's not just about the Excel spreadsheet. It's also about your specific heuristics and your biases and how you treat money and how you handle money and how you think about it, how you live your life. Is this something that you want to basically be a part of for the rest of your life? Because here's the thing, once you commit to this, there's no going back. You cannot get out. Once you put money into this strategy and you grow it for a year, 5 years, 10 years, okay? Here's the thing, you have to wait until you die. If you collapse the policy, it becomes taxable. So what I mean by that, if you say, no, I'm done with this, cancel everything, get me out of this, it becomes 100% taxable. It only is tax-free if you wait until you die. And so when you commit to this, you commit to it until the very end. And if that seems like a scary proposition, it should be. This is something seriously that you should think about and consider before you actually move into it. However, if you can get over all of the negatives that I just put there, this is an excellent way to build your wealth, especially for high income earners that are comfortable, one, with leverage, and two, they just have extra capital. And it's I'm not going to lose my job next. I'm secure. Even if I lose my job, I'll get another one. I know I have this money coming in. I can commit to this. So if that sounds like you, this really could be an excellent strategy for you to build your wealth and borrow it, write off the interest if you want to, put it into a business, put it into another investment, and grow your wealth. It can be a very excellent way to do that, but you can see there's so many strings attached. Now, some of the reasons why it's so beneficial for high income earners, and I say this again and again and again on my channel, and by the way, I made another lengthy video where I detailed this invest in life insurance strategy versus a RRSP strategy, and I compared it apples to apples. And there's the one variable which you need to consider, which is taxes. And by the way, if you're interested in that video, just drop a comment below. Invest in life insurance. It's 40 minutes long. I go into the nitty gritty. I explain exactly how it works. However, here's the one variable that makes this strategy so worthwhile: taxes. When your marginal tax rate starts to get higher and higher, it doesn't matter about all the other losses and the drag on this type of strategy, the fees, the interest rate, all the other things that are associated with it. When your taxes start to reach a certain level, that becomes negligent, because even with all that drag, it's such a good strategy because your taxes are so high that it doesn't make sense to invest in any other type of taxable investment. This becomes the haven. This becomes one of the best strategies that you can put your money into. And it also makes a lot of sense, again, if you have that extra capital that you can allocate towards this. However, for the vast majority of Canadians and Americans that are the low to middle income earners, 70% of Canadians make less than $80,000 a year, okay? And so when you start to actually look at that population, there's just so many less committing, less strings attached, and easier to understand strategies that are available, such as all the other registered accounts that you have in the States, 401k and all those other ones. In Canada, your TFSA and your RRSP, they're already made there, and they're simple, they're easy to understand. You can contribute 1 year, you can stop the next year, you could do it again the year after. If you need to take a break for 3 years, no problem. If you need to take all your money out all of a sudden because an emergency came up, there's no problem. So for the vast majority of Canadians, I just don't think that this is the best strategy for you to go into. I think there's just way other easier ways to put your money that's just simple. There's not all these strings attached. There's not a lot that can go wrong. And so I'm not saying that it's the worst idea. I'm just saying it's much better for the high income earners. And if you look at any of these TikToks and all these other things, they're always talking about the rich do this, billionaires do this, millionaires do this, banks are buying this, NBA players are buying this, rappers are buying it, all these other people are buying it. Do you notice they all have something in common? They're all rich. But just because rich people are doing something and it's a good strategy for them doesn't make it a blanket strategy for everyone. Does that make sense? So if you want to get into infinite banking and invest in this type of strategy, there's 4 things that I think that you need to be ready for. Number 1, you need to be a high income earner. That's really when it makes the most sense. Number 2, you need to be comfortable with a high level of commitment. This is not a year or 2 years or 3 years. This is for the rest of your life. Number 3, you need to be comfortable with leverage. Wrap your head around the concept that just because it's debt doesn't make it bad debt. And if that's something that's hard for you, maybe this isn't the best strategy for you. And number 4, you need to be ready to join a little bit of a cult. Here's the thing. I had some really good conversations with all the infinite banking practitioners that I talked to. And if any of you guys are watching this, thank you for meeting with me. However, they flat out told me that I needed to brainwash myself, unlearn everything that I know, and that if I wasn't distrustful of banks, governments, and other institutions, I wouldn't be the best person to work with. And so if that rubs you the wrong way, they might not be the best people to work with. However, if you are very distrustful of banks and government and all these other institutions and systems, and you want to go towards that very right-wing leaning marketing and all that other stuff, they could be the best company for you to work with. So with all that being said, I hope you guys enjoyed this video. And as always, if you guys enjoy this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.